Tyler, we've both been in a little bit of a buying mood lately in our stock portfolios. We're going to talk about each a stock that we've added to our portfolios. And in both of our cases, it's companies that we've both followed for a long time that we decided it's time to pull the trigger and make them part of our portfolios. You ready to share these stocks and help people watching figure out if maybe it's a stock they should think about buying too?
These are stocks I think you and I have talked about quite a bit for a long time, but I think we both decided it was finally time to do it. Although with you, with that giant portfolio of yours, that buying could be just a Tuesday.
Fair enough. Fair enough. That's sort of true, but less true than it used to be. I'm Jason Hall. This is Investing Unscripted. That's Tyler Crow. We got two great stock ideas we're going to talk about for you here. But if you want even more great stock ideas, you should go to our special link. It's fool.com/unscripted. Go to that link and you can get access to the Motley Fool's 10 best stocks to buy right now. Take the time, check it out. It's a good investment in supercharging your own portfolio. Okay, Tyler, how about you kick us off?
All right, so I think we talked about this one pretty recently, and it was almost like a what am I missing because it was so cheap? And that's Canadian Solar. As the name suggests, they're a solar panel manufacturer, but in addition to panel manufacturing, they actually have a project development arm, which I think is probably part of the reason why it's been hit so hard. You could maybe chalk some of it up being tied largely to China with its manufacturing based in China. So maybe the Chinese slowdown was a little bit of that, the project development. But what was the initial reason I looked at it? I was like, man, this thing is cheap. It was trading for 0.4 times book value. Allegedly, this thing was trading for pennies on the dollar. And I was trying to figure out exactly why. And I still can't exactly figure out why it's trading for so cheap, but that's okay. I think I'm gonna take a stab at this company anyways. So solar panels, it's a very cyclical industry. We've talked about it before. Demand is skyrocketing, but it goes through massive waves of oversupply and undersupply globally. And so you can't exactly buy these things at any given time. It's been a little bit of a pricing lull, part of that being from tariffs in the United States. So it's getting a little bit lower pricing here. About 20, was it 27? Oh, sorry, 30% of all module sales in the most recent quarter actually went to North America. So they are pretty leveraged to the North American market. On the China slowdown aspect of it, it's less than 30% of shipments go to China. So it is a pretty global player. And its total shipments are still growing at pretty decent pace. It expects to ship somewhere between 32 and 36 gigawatts of solar production this year alone, and it's gone from 3% of the market 15 years ago to about 8% today. 18% gross margin on sales, not great, but for a commodity product like this, that's fine. And then the thing that's interesting to me is that they have this project development arm, which admittedly it's very lumpy revenue, very lumpy earnings because they have to kind of hold the asset on the books while they develop it and then they sell it to somebody built ready to go to an operator. Well, one of the things that's changed a little bit in the past few months is they closed a deal with BlackRock with its development arm where BlackRock is going to take on some of the financing risk associated with this so that when the deal gets sold, it can take some of the profits on it. And that was about a $500 million investment in the project development arm. And that the pipeline for that project development arm is huge. I was saying it's got about 36 gigawatts of production this year. Its pipeline is about 27 gigawatts of production facilities or that it's developing in-house, and that's not selling to third parties. On top of that, it's got 63 gigawatt hours of battery storage project development in the pipeline as well. So you kind of combine those two things together and you have this massive pipeline where they've had to like put money into the business where like a lot of working capital, I guess if you will. And as that starts to release, as those projects get developed and get sold, you're going to see some I think there's going to be some pretty substantial increases in earnings on top of the growth that we're seeing in the panel production and the panel sale market, which they're still growing production pretty well and expects to continue growing its production at a pretty steady clip over the coming years. So for all of that, despite the incredibly cheap price that it's selling at, I don't expect it to sell for a massive premium to book value, but even getting back to zero point 0.7, zero point 0.8 times book value would be, I think, a pretty monumental swing for this stock. And I think that eventually people are going to come around to the growth that this company has been posting.
I want to show a chart here just for context. This line here, this is 0.8 times. 0.8 times book value is not a huge stretch from where we are right now, right? It's not too far off. I'm going to put a couple of things on here just to overlay. And you see there's kind of an inverse correlation between the blue line, which is the federal funds rate. That's when some people say interest rates are getting cut or raised. This is what they're talking about. So again, through the zero interest rate environment during the COVID period, we saw again, this is price to book value. You can use it as a proxy for the stock price, skyrocketed and stayed relatively high. And as interest rates have come up, it's started to come down because another part of Canadian solar business that's affected here, besides the utility scale, large projects that they're building and the panels that they're selling to other developers to use in these utility scale projects, they do have some residential that's part of their business as well. And as interest rates have gone up and things like net metering 3.0 in California have happened, it's put a lot of pressure on the residential solar business. And that's affecting Canadian solar as well. Maybe less material impact and more of the perception of that impact from the investor class that thinks of all solar as, and a lot of times, as being the same thing when they're not, right? You have like Enphase that's 100% residential solar. And then you have a business like Canadian Solar and First Solar that the bulk of their business is utility scale. So very, very different customers. Cycles can overlap, but the cycles aren't even all the same. But the point is, I think, Tyler, you nailed it. This is a business that's priced for nearly insolvency, certainly for trouble and some big losses based on selling assets for maybe less than it's paid to build them or develop them. And I think that's wrong. I think you're right. I think just a normalization of the valuation is worth a lot of money here for this particular stock. Okay, I got a stock to talk about too. Tyler, what can Brown do for me? Hopefully serve as some ballast in my portfolio and give me like a certain level of return that I think is relatively safe from a high dividend yield, nearly 5% at recent prices. They've been growing that payout. Growth might not be great for the dividend going forward, at least for the near term, because they are in a position where the business is kind of having to turn around. So what I've got on the chart here, again, you see the stock price peaked 2022 and has continued to sell off over the past 2 years plus here as the business tries to get through some challenges that they've dealt with based on revenue. So again, this is single digit revenue growth that we saw, and it's cyclical. Tyler, we've talked about this. It's very much tied to how the economy's doing. And business right here, they were trying to move away from Amazon in the late 2010s. So we saw some reductions in growth rates. And then what happened here? Boom, this is the pandemic. Guess what? Everything had to get shipped to everybody. Packages had to get delivered to people's houses. Going places to get stuff was much harder. That revenue growth continued. Problem, Tyler, is a lot of that revenue growth was not high quality revenue growth. It's weighed on earnings, lower margins. And we've seen as things have gotten to a certain level of scale, Amazon building out its own internal distribution network, DHL starting to try to move back into North America, some other challenges they've dealt with. And we've actually seen a couple of quarters or a couple of periods here where revenue is starting to decline. The key, though, I want to say this is I don't want to say they're trying to make the business shrink, but they're trying to make the business shrink. They're trying to right size the business. They're going to decrease the number of locations that they have and really focus on better opportunities in some better markets. They just made a deal down in Mexico. Another video we did recently, you talked about a company in Mexico that is exciting to you. I talked about how that market is dynamic and growing. Well, UPS realizes that as well. They've got a deal to acquire a logistics business called Estafeta in Mexico to help find growth where the trends are really favorable.
Listen to that pronunciation. Great job, buddy.
I do the best that I can. Muchas gracias. That's terrible. All right. So what else can Brown do for me? So they can stabilize the business. And again, that is their plan, bringing margins up by focusing on the more profitable parts of the business and deprioritizing things that are lower margin. Now, what else can they do? They can continue to focus on repurchasing shares. About $1 billion a share a year. What is that worth? A little less than 1% of the market cap at recent stock price. It's about $114 billion business. But it is a product, it is a way to start delivering a little bit of per share value for investors. There's concerns that this is a dividend trap. You look at the payout ratio based on earnings or cash flows, and you say, wow, 102%, that dividend's in trouble. Revenue's down, earnings are being squeezed. Are you walking into a dividend trap? Could be that way, but I don't think it is. I don't think it is. And here's why I don't think that's the case. So you look at total dividends paid, about $5.3 billion. in dividends a year that they're paying. Again, this is a negative amount means it's money going out the door, right? So again, they've grown that as they've grown the payout. And you look at it based on free cash flow, and yet this is why it's negative. But if you look at operating cash flow, it's well protected. There's a substantial amount of operating cash flow here. So how do you bridge that gap with free cash flow? Because this is a very capital intensive business, and they're telling us what they're doing. They're slowing expansion. They're focusing more on higher return developments, and they're reducing their footprint as well. So I think we're going to see CapEx start to come down because they have been aggressively spending to expand over the past decade. And I think they can start pulling back on that as well. And I think the dividend is going to be safe. I think over the long term, the reason I bought this is because you have that high floor here with a dividend yield that's close to 5%. As I said, I think the dividend's quite safe. That's a good starting point for income. And if they can get just a little bit of traction with their turnaround efforts to strengthen the business and grow where the margins are best, I think this could be a really good winning stock for the long term.